So the LME, tell us a little bit about the LME, how long it's been in existence, how long you've been electronic, and perhaps a little bit about the mix of the market. How much is electronic and how much is non-electronic?
The London Metal Exchange is 135 or thereabouts years old, so slightly older than I am, and it can trace its origins to the invention of the telegraph. So when the telegraph allowed communication across the planet, trading in shippable merchandise originated in London in a number of commodities, and the LME, as the name might suggest, focused on metals. And so you have the scenario of coffee shops in London where people step into what became a chalk ring on the floor, where someone would say, I've got a boat leaving Santiago, Chile, with 10 tonnes of copper on it. Who wants to buy it? It'll be here in 3 months. Similarly, 10 tonnes of nickel leaving Kuala Lumpur would arrive in London roughly 3 months later. To this day, our most liquid contract is the 3 months outright. So the exchange went through various forms, but basically can trace a continuous history of trading base metals over 130 years. 2001 was the introduction of the first electronic market, but the open outcry still exists and is in fact the last open outcry market in Europe. We also have a 24/7 telephone broker market, so we actually are 3 venues in one, all of which converge through a matching system, a single matching system. And despite predictions across the press and various other analysts about the demise of the open outcry, the ring, it hasn't happened. We continue to have a very vital open outcry market, a very vital telephone market, and an ever-growing and also incredibly vital electronic market.
So clearly you've got diversity there. You talk about 3 different distinct order book types. You know, if you were a new exchange or an up-and-coming exchange, we've got lots of people here in the audience today. What technology infrastructure, if you were going to rebuild, start doing it today, what would you put in place? What would you put in place for pre-trade? What would you put in post-trade? And what are the sort of new innovations that the LME are looking at for the next year to help drive some of those things as well?
I mean, that's a massive question. I think it would take us all day to discuss all the things that one might want.
Well, since I've stepped in as chairperson, it might be quite a good thing, but
clearly regulation these days requires you to have a number of systems that weren't required many years ago. In our case, probably one of the key to the LME is the matching system. So where the 3 venues converge is where you first have visibility. And in some cases that's post-trade visibility because the trades have been agreed by telephone or across the ring. Clearly, pre-trade, there are a number of things required, and again, that would depend on your regulatory regime as to what would specifically be required. In our case, it extends to things like video recording of the open outcry, which is an essential part of our trade surveillance. But I think, one of the lessons I've learned is that what you know from another exchange doesn't necessarily apply in yours. There are a lot of unique distinguishing factors about the LME which are based in history, but also based on what works and what continues to work for the member firms. So I don't think there are one-size-fits-all solutions in the exchange world. You can see people launching new contracts, new businesses in one geography that work perfectly well in another and failing. And I think there are a lot of questions regarding regulation, regarding, in some cases, cultural things. The Sharia rules in a large part of the world require a different kind of trade than what we might find works very well in Europe.
So your advice to our audience here is that, look around. There might be some things that other exchanges are doing, but actually you do really need to work things out for yourself and work out your nuances for your own market.
Totally, and depending on who you see as your ideal participants in the market. So if you're seeking global participation, the participation of the big investment banks and so forth, there are certain must-haves. But equally, if you're looking at a more retail market, a more localised market, you need to research what that market expects and demands. What is going to work for them? In the case of the LME, I mean, primarily we serve industry. in as much as if you're a producer or a consumer of base metals, we provide a very useful hedging service. I think there's a misconception out there that the so-called liquidity providers, the hedge funds and so forth, actually drive the market. They are very valuable contributors, but actually if you don't have a base purpose, in our case industry, you're unlikely to succeed.
So I think you're resonating with some of the comments that were made yesterday on some of the different panels, particularly in the mainstream, that it takes all sorts to make a market, and that nobody should be put in one bucket, and nobody should be. If anybody watches Super Nanny on the naughty step, I think there were certain market participants that were perhaps sort of derided for completely the wrong reasons. So you're saying that actually you need all parties to come to make a market.
Absolutely. Yeah.
And you touched on the post-trade environment. Is there anything new or innovative that the LME is doing in the post-trade world?
It's fair to say we are currently looking at a real-time surveillance system, for example. And it's fair to say we're a little behind where we ought to be with that. And regulation will force us all to improve our systems in that regard. We have a very well-schooled and very disciplined compliance department, but they probably don't have the tools at this point in time they deserve to have. So we're very close to implementing a new real-time system. Of course, there's no such thing as an absolute real-time system, because by its very nature, you're actually looking at something that has happened. The question is, how long after it's happened can you act? In our case, it tends to be minutes, if not hours. The new system we're looking at will be seconds after a bad trade.
Well, I think we've got a panel a little bit later on talking about real-time and real-time risk analytics, and it's particularly poignant, particularly as you've seen the news overnight from the US around the swaps market. But we'll be able to debate that a little bit later on. Do you think that in terms of compliance and the onus on those compliance officers, I don't think you're alone in the exchange world, and I'm sure we saw lots of people nodding when you were just saying that would resonate with many people. Do you think that is true, that many people are finding that the compliance and regulation is putting more and more pressure on where you would have had innovation perhaps in other areas? Actually, some of that IT spend and some of that infrastructure is very much having to go in the sort of regulatory space now.
It's the speed of trading that's driving this as well, because in the past where trades were being inserted by keyboards and fingers, the badness was more easily spotted, let me put it that way. Now with the increased flow that comes from algorithmic trading, badness can happen in nanoseconds, and we need to be able to react to that and prevent bad trade, but also act on it very quickly, because once an illegal trade has happened, the consequences of that are more than that trade. You may have moved a price, which is now affecting a wider market, and you need to be able to unpick that very quickly. We're currently not as well equipped to do that as we ought to be. That's where we're moving next.
And before we bring up our transatlantic pioneer, does anybody from the audience have any questions for Michael? I know it's early. Come along. Somebody must have a question. We'll have to see if we can find a prize. Anybody? Well, there we go. So, the transatlantic pioneer, come on down.
That's a first.
There we go, technology. You put your iPad down for 1 minute and then... I know, low latency. And all your notes disappear, but fortunately I have some paper backups as well, so there we go. So, CIO of Tradition, everything that you've done in terms of innovation around ATS, MTFs, you really are a pioneer, and so you know about diversity in the market, and that's what we're talking about, diversity in terms of infrastructure. So you know what it is to be nimble. So what do exchanges have to do, and what advice can you give to the audience here about being nimble, being innovative, and being a pioneer?
Well, I think the first is that when you have a good idea, you have 6 months to implement it. So you're not the only person intelligent who has the right idea at the right time. Everybody can have the same idea. So it turns out to how long it's going to take you to implement your functionality, oh, I've got a bright idea, let's bring it to the market. Somebody on the other side of another company will have the same idea, and the one who is going to implement it the first time will have the first mover advantage. That's the first thing. The second thing is about flexibility. Regulation evolves very fast. Your customers evolve very fast. So you have to have systems that you are able to change and modify very quickly, whether it's in the field of trading. Trading is less important. Surveillance is a very important aspect of it. And there was a panel yesterday talking about surveillance of the market across different and various markets. And I think the most important thing on that field is to make sure that you can adjust your surveillance system as fast as the market is evolving and as fast as the market is, inventing new algorithm, inventing new way about getting to the liquidity that is on your exchange.
And you talked there about innovation. As soon as an exchange is innovated, it then creates a sort of tsunami wave and an impact on everybody else. Do you think the data providers, do you think the other providers in the market are able to keep up with the rate of change that's there? Do you see that ripple effect, and is it a tsunami, or does it sort of just trickle?
I think it's the same thing than when Apple brings something to the play. They bring iPad or they bring an iPhone. 2 years after, everybody has copied the interface, the user interface of the iPhone, or bring up a tablet PC, and some of them are more successful than others. If you look at BlackBerry and the tentative they did to bring a tablet of their own, they were miserably unsuccessful on it. So every time there is a pioneer idea that makes sense, you have some people who are able to follow and some people who are going to be left on the side, and it takes very little to be left on the side. You have the right decision at the wrong time and you're done. So I would say the exchanges for the past 20 years have evolved a lot. And the reason they have evolved a lot, and they did not have the choice. When you saw the ATS coming in the US, BATS was now an exchange, and the other dark pool, when you see the MTFs in Europe and Tri-X come on board in turquoise and BATS coming from transatlantic, the exchanges didn't have the choice. They had to evolve. A lot of them did that through technology. The London Stock Exchange acquired Millennium IT. So when they could not get nimble enough with the internal IT, the internal staff, what they did, they went to the market, acquired a company because they have the big money to be able to do it, and then transformed the company faster in doing it this way.
And from your wearing your current hat of CIO at Tradition, what are you doing to diversify, and what are you doing in the next sort of 12 months in a sort of, if you can share that with everybody in terms of your technology roadmap?
I can share a little. I won't be able to share everything, but the big difference between first of all, Tradition is, for people who don't know what Tradition is, it's an inter-dealer broker. There are 5 inter-dealer brokers in the world: ICAP, Tolet, Tradition, BGC, GFI. Those are the 5 biggest ones. And the parallel that we can draw between an IDP and an exchange is the fact that an exchange provides the technology for buyers and sellers to, most of the time now, electronically exchange shares in an equity derivative. An IDP does the same thing on the OTC market. So it's not one asset class, it's dozens and dozens of different asset classes of the OTC market, but they do that through either voice. So you have a broker, not the broker in the sense of an investment bank broker, but a broker, like when you look for a mortgage in the US and you call your broker and they find for you the best rates. It's the same thing. A broker on the OTC market gets a call from a trader from a bank that says, I want to buy, I want to sell an interest rate swap of 3 years, etc., etc. And the brokers give indicative prices based on his knowledge of the market and try to find the counterparty. So a broker is a liquidity provider, a liquidity seeker, not provider. Similar to a central limit order book where basically everything is displayed. So it's not dark because it's displayed, but it's not displayed in a central limit order book. It's voice trading.
So you call it grey?
There's different shade of grey, but it's not available for the public. Okay, so it's not. There is no. You can't look at. You can look at a Bloomberg terminal and see some price, but you can't look at in the street and see. Oh, that's the price of the which nobody cares about the 3 years euro swap. Anyway, the second part is you have a type of trading that is hybrid. So where basically you have the voice broker and interacting with a system, similar to an exchange. When basically you go in some exchange, you have special terms in which you have an order in the book and somebody can come and hit and take that order and grab it. And you have electronic trading also, where basically brokers put orders and those orders in a book, and those orders are available to be traded either by a trader or as a broker. So that's what an IDB is. The biggest issue that we have right now is similar to the equity market. We're going through, I'm not going to say, I hate the word revolution. So we're going through an evolution where basically that OTC market within the next 5 years will transform itself. Some product will stay on the voice, some product will become hybrid, and some product will become electronic. Electronic means it could be a central limit order book, but it could be also a system that manages requests for quotes, for example. So the problem today is trying to determine which product will stay the way they are, which product will evolve based on, one, the regulation, and two, more important than the regulation, I hope there was not too many regulators in the room, but based on what the customers are going to want, the customers being the banks. In the fields of the trading, how the trading will take place, but more importantly, the pre-trade transparency and the post-trade risk management, going to central clearing houses and going also to the trade reporting facilities.
So, Michael, I think this resonates with some of the things that you said. I'm very conscious you've sat there listening to Yann. You know, some of the things that he talked there about, again, about the pre-trade and post-trade transparency. Do you see that, you know, that there could be conversations between your two organisations or between other organisations? Is there a place in the market for greater collaboration between venues and exchanges than we've got to date?
I think that's an evolution that would always continue. I mean, I am very, very old, not as old as the LME, but you know, I go back to an era where everyone wrote their own software. That is increasingly that's less and less the case as we move on. So the existence of companies like Millennium, like Sonoba, and then many other companies that are displaying their wares in the exhibition hall was unthinkable 30 years ago, simply because everyone did their own stuff, and there was no real market for these things. The costs were too great. And of course, what's happened now is there's more and more organisations with a similar need, which has allowed for the emergence of companies that make not commodity software exactly, but software which is largely reusable from one venue to another. I think our needs are very, very similar.
Now, I'm very aware that this is supposed to be a debate and a discussion, and we're a nice small room here, so we can really get some lively debate and discussion going from the floor. So who would like to kick us off? Tahir? David? I am going to pick on you. Tahir, well done. Oh. David? Anybody else? Ezio? No? There we go. Well, clearly, everyone's had quite a late night last night, or we're
we addressed all the subjects already.
Or we've addressed all.
Or they are bold.
All of the questions. Well, perhaps we should vote. You know, well, you're quite right about the number of vendors. You know, in terms of solutions there. So, do you think if you were setting out today, would you go and buy technology, or would you go and build technology? I know, Yann, you've got experience of both. So, which would you do?
It's a very, very good question, and it really depends. It depends what is it that you're trying to achieve, what is your short-term, your medium-term, and your long-term objective. At Tradition, we decided for a certain type of asset class, we decided to build our technology from scratch. And the reason we did so, no offense to our colleagues from the software houses, but we wanted to keep our intellectual property. The OTC market is a big market, but with a small number today of players on the technology field on the electronic side. Give you an example is, today the latency, let's talk about latency, we haven't talked about it for 24 hours, so let's bring it back. I think it's a subject everybody is interested in. It's 100 microseconds response time on the equity market. On the OTC market, an electronic book that is very fast on the interest rate swap market is 20 to 25 milliseconds. So 20 to 25 milliseconds, if I remember correctly, was the speed of the equity market back in 2004, 2005 maximum. I think 2005, yeah, probably. 2007 was 10 milliseconds. So it was 7 years ago. But what the difference is, the product, trading an interest rate swap is a very complicated product because you have implied order calculation, you have a lot of things to take into consideration, where equity trading is pretty simple. We didn't want to give away that intellectual property, the things that we know best to do, so we wanted to capitalize and develop our own system. And the exchanges have understood that very well, because what they did originally was to build, and then to outsource, and then to insource back by buying the companies, not by redeveloping anything from scratch. You will see little exchanges, still exchanges today, buying from scratch something. They go and they buy companies, and they absorb the companies and just re-insource everything they have outsourced. But for other asset classes where it's a commodity, or there is not that many IP behind, it doesn't make any sense to build, because building costs a lot of money. So where it makes sense to build the asset for the valuation of the company, number one, and to keep our IP, we do it. And when it doesn't make sense, we go and we either buy or we license.
So, Michael, we talked about earlier, or I talked about earlier, where we had the quote about, technologies and a shelf life. If we've got a situation where we've been out and we've bought something as an exchange because it's the right solution, but we want to grow as an exchange, can we build on and add other components? And what are the sort of issues from a technological point of view in terms of, putting together a jigsaw to be able to expand out into other asset classes or other domains for an exchange?
I guess a jigsaw is a very good analogy for it, because I think most exchanges will have a variety of vendors. I mean, I totally agree with what Yann was saying there, that typically you will buy, but there are occasions you want to build your own. You want to make it those things which are unique to you, your own property. And certainly we think long and hard about intellectual property. We have licenses, perpetual licenses for most of the software we use, but we typically own the IP and any modifications that are made by the vendors to that software on our behalf. I think one of the key lessons I've learned is that given the rate of change, you must constantly re-examine decisions which were great decisions 3 years ago, but which might now look wrong, and that it is a constant. You can never rest on your laurels with the growth and the speed of change. Regulatory change has been one of the key pain points for us, that it's anticipating what the regulator is going to want you to be doing in a few years' time as you're building now. Most of us get that wrong. We're unable to read the minds of the regulators ahead of time, though there are some logical expectations in that field.
So if you're saying that you have to stay nimble, that you have to constantly reevaluate, so you're like Formula One, always tinkering under the bonnet, always constantly changing, does that mean that your purchasing and the way you purchase will change? Do you think that people will go from, say, a capex or an opex model and switch it around because you have to stay more nimble, or do you think people will just throw money at it here, look under the bonnet, think they need to tinker, throw money at it again? Do you think there will be a shift in the way people buy and the behaviours around that? Yann?
Two things. One, the capex and the opex is more a cash management than anything else, depending on the way that we want to capitalize our development, or we just want to write it. It's a different perspective. But I believe it depends when technology starts to become a commodity, then you don't build anymore, because it doesn't make sense. It's too expensive, and you can just pick up within one of the vendors and pick up the best and just buy it from them. We're talking about yesterday software and hardware, and starting to have software mixed with hardware and FPGA and appliances. Well, this is when it starts to become a commodity, because you are not, as an exchange, going to develop yourself FPGA technology, or unless you want to basically, it's very expensive to do, and unless you want basically to resell it to the market. So we're going to see a transition where things that were proprietary to exchanges will start to become commodities, and new things will be developed, and those new things will then, it's a constant cycle about innovation. So that's probably the best way to answer the question.
Michael?
I mean, key for me is actually to have good relationships with your suppliers, because you don't always necessarily pick the absolute best for a specific need. If you have a partnership with an existing supplier who can supply and develop on to something which is better, we've had very good relationships with our suppliers, which have led to some really good innovations, which you might call LME innovations, but were actually the product of a partnership.
Now, on the dot of 10 o'clock, that hopefully means somebody has woken up. I see a hand in the back there. Youssef, yes? Please say your name and organisation and your question, please.
Hi, guys. It's Youssef Hafiz from BT Radiance. Michael, Yann, a quick question for you. You both spoke about there are times when you would develop technology and times when you would go and buy it off the shelf. Is there any guidance you can give which says this is when we would develop ourselves? I mean, what are kind of rules you have internally to say this is what we will develop and this is what we will buy off the shelf?
I mean, the first test for me would be, does it already exist? Do we need to reinvent this wheel? Because it would be pointless to spend, it's always going to cost you more to create it from scratch. The second test would be, is what's out there suitable for my market? And also, you know, is there any competitive advantage to our organisation from having something a little better than everyone else, or do I just need to tick some boxes here? You know, do I need a matching system, a compliance system? You know, can I describe it as something quite generic that exists elsewhere? Then typically we'll buy that. But if it's something where I might actually get an edge on a competing exchange, then we would consider doing it, you know, with a partner, but doing a development.
I'll make a business answer. It's return on investment and long-term strategy. When we launched Turquoise in 2007, we had 8 months to launch a platform. You don't develop an equity trading system for high-frequency traders in the market in 8 months. So when you want to compete and you are not the first one, then you probably have to license something from the market and do your own customized development. And at the same time, if you want to have a competitive edge and if you want to increase the value of the company and you have really the perfect mousetrap and you probably want to develop it for the long term, depending what your strategy is. If you're only on the trading of stocks like the MTFs are today, you just may want to license. If you have a bigger aim in life of your company and you want basically to go into merger and acquisition or you want to diversify, then I would say you should probably develop it yourself.
I've got a second question, and it might be an item which is on the agenda for later today, but perhaps I can ask you anyway. Do you see, it's not like, you know, it's not something we covered in a session early on, but do you see something like cloud services enabling and speeding up your product development, or do you see it as a so what?
Just have repeat the question.
Do you see cloud services as something which will enable you to increase your product development, or do you see it as a so what?
For me, it's reducing my cost.
We've used the cloud and it's facilitated the deployment of a developer who lives not far from here, actually, in the Mediterranean, on one of the Greek islands. That is doable without the cloud, but is a lot more doable with cloud services.
Any other questions from the floor? Mr. Michael Cooper, I promise you this is definitely not fixed, just because it's another question from BT Radiance. Yes. But actually, perhaps they're the only people that are lively enough to ask some questions this morning. So,
yes, apologies for the group push. So Michael Cooper, BT Radiance. Just picking up on something you said, Michael, I just wanted to, is there a way that you can leverage your IP without giving up competitive advantage?
I guess it depends what the IP is. Yes, in as much as as Yann said before, it's a lot to do with speed. And if people are rushing around copying you, that's usually a good sign that you are leveraging your IP very well. In other cases, you can, as has been done historically with a number of companies, if it's something that good that you can productize it and on-sell it, you're always going to have the first version, as it were, and have had the first mover advantage. But why not sell it? Make some more revenue if it's that good an idea.
Yann, do you have an opinion?
Yeah, I mean, again, I'm going to make the analogy with Apple when they launched the iPhone. I mean, I'm probably one of the few in the room that doesn't like that much the iPhone. I think prefers some different type of Androids. But when you are the first one to release something that's very innovative, you're right, you're going to get copied. And people are going to make things better than what you did. So to keep your competitive advantage, and I think Apple did very, very well, you have to constantly innovate. You have to constantly come up with new things. You can never stop. This is what makes our industry and our job so much fun.
Now, a question from somebody who isn't from BT Radiance. Come along. It's 10 o'clock. Everybody should have woken up by now. Coffee should have been working. Is that Ulf there trying to have a question? Tahir having a question? No? David? No? I mean, the headline on this panel was diversifying, if I can get my teeth in, diversifying into the derivative commodity or OTC space, and the technology that's needed for that in particular. I mean, we've danced around the topic in terms of buy versus build. We've talked about, how you can do that in terms of capex and opex. Is there anything that we have missed in terms of? I want to make sure for the audience that we've actually answered the headline, in terms of the panel question.
Yeah, I think that with regard to the technology itself, the things that are going to be important in that space in the years to come are the ability to gather and consolidate all of the trading information into one set of standardized messages so we can trade report. The CEF regulation is coming in the US, the OTF regulation and OTC regulation is coming in Europe. We have tons of different systems trading different asset classes, different way, voice, electronic. But at the end, all of those transactions, all of those trades will need to go to trade reporting. We call that tape reporting, but we call that trade reporting. And the investment banks are going right now through what they've started in 2001 and stopped at the time, which is STP, and STP in the OTC space. So whether we are talking about going to central clearing with most of the product, or whether or not we're going to the STP system of the banks, it's about risk management. So the venues like us, the main focus, of course, is on the field of trading, but the liquidity on the trading is not the same liquidity done on an equity market. I was saying yesterday that the average trade size on the equity market in Europe is probably around 1,500, 2,000 euro every trade. In our markets, it's 75 million euro for a trade. It's 40,000 more. So when we do 20 trades a day, it's the equivalent of 800,000 trades on the equity market. So we don't have the same problematic on the trading, but the STP and the central clearing, all the plumbing that goes out is the things that we have to focus on. And the things that is really an issue for us, and I think it's the same for the LME, is what we call pre-trade transparency. Michael was talking about the fact that they are video recording the ring. That's pre-trade transparency. What we are doing when we do voice trading, we're using those dealer board, those turret, from those big telephone banks with a lot of different lines. When you have somebody on the phone trying to determine what the price is, this is the equivalent of an order going to a central limit order book and getting modified, getting cancelled and replaced. We have to basically get that and standardize that so we can survey our own market. So that's the principal technology that we're looking at this stage.
Yeah, I'd echo all of that. I think the key to us is trying to second guess what the future holds, both from market needs but also regulatory needs, and trying to build systems which are flexible enough that you can configure them to accommodate those changes. what Yann was alluding to there is very important to us at the moment, is trying to work out what the trade repository of the next year or so actually means. There has been a divergence between Europe and the US over the last couple of years. So building something that might fit one might not fit the other. As a global market, we need to accommodate both, and there is some competitive advantage here in actually being the venue that holds that trade repository in your asset class, because there'll be a stickiness between the on-exchange and OTC markets, which I think is for us to lose or capture.
So you've got a blank piece of paper. It's 2012. You know, who knows who will meet up in WEC, the World Exchange Congress 2013. If you've got one single piece of technology that you can buy, or one single piece of technology that you would like to invest in, or to be a solution with your blank piece of paper, what would you write on it?
Oh, that's a tricky question. I didn't expect that one. I need to think.
Well, we can ask Michael to do.
I need to think a little bit.
We can ask Michael to do his singing. Well, actually, first, what do you play the guitar? Do you sing?
No, I don't sing, and you don't want me to hear. You don't want to hear me singing. There is the technology I would invest on, not one technology but multiple technology. I think the first one is probably in the field of hardware and software, probably in the field of FPGA. The second one is in the field of complex event processing, and specifically because complex event processing today, and we did that at Turquoise with our surveillance system, and give the ability to absorb and to consume a lot of different data in parallel from different streams, and to basically apply different patterns to it. And it has been proven, at least to my experience, to be potentially one of the most flexible way of serving the market, or even in a ticker plant way. So those two technologies are probably the two one I would
It's
look
quite
at.
interesting you bring up the CEP, because one of the things that we found recently is that we've had many phone calls about CEP as a SaaS service. So really taking that to the next level, you know, really including CEP in the cloud. So, right, so you heard it here. So next year when you see Yann, you'll be able to say, actually, you were spot on hardware and software, or you were spot on about CEP, whether it's in the cloud or not. So your bet for the year?
I doubt we'll get it, but I'd love to have the ability to order a network line, and have it put together in less than 3 months.
Well, if it's BT Radiant's line and it's on net, you can have it in 5 days. And not here to plug. So we've got literally 60 seconds left before we do a countdown with Michael singing, with Yann humming, and myself tap dancing. Has anybody got a question for the last 60 seconds? Oh, here we go. Well done.
It's like on the LME, it's like the last minutes where everybody
I know,
gets
exactly. Well, yes, I thought bring some excitement to the morning. Right, sorry, say your name and where you're from.
My name is Vladimir Kulyanchik. I'm from Arca Technology Company. My question is about following story. Last months, maybe years, quite modern theme for exchanges is to introduce pre-trade risk management in their platform. What do you think about this in your particular cases, and do you plan to do it, and if do you plan to do it with some partner, or do it by ourselves?
You have to be very careful with pre-trade risk management. We constantly reevaluate where is the line of responsibility, because I think there's a danger if an exchange introduces a pre-trade risk management system that the market participant might think they've been relieved of that responsibility. We make it very clear they have not. So in our case, the pre-trade risk is all about protection of the venue. So it's things like circuit breakers and throttling, and just things that protect the venue from mistakes, malevolent code, whatever. But the actual pre-trade risk management that most people refer to is the responsibility of the market participant, not the exchange.
Yann?
Yeah, I do agree. An exchange is there from an order standpoint to protect its system and to protect its customers. It's everybody's at the same level in an exchange. You're a customer, whether an HFT or an institutional or retail member, you have the same rights. So we have to protect our systems against any sort of issues that can be generated by orders coming to it. But I agree with Michael. The pre-trade risk management is the responsibility of the users.
Thank you.
Last one in the last 20 seconds. Well, ladies and gentlemen, we've heard from Michael and we've heard from Yann. We've heard about evolution. We've heard about being nimble. We've heard about jigsaw buying in terms of buying the right component parts and customizing the technology for you to be able to diversify your exchange, to be able to take OTC and other asset classes. We've heard from Yann in terms of that evolution, that OTC is going to take a little bit longer. It's not going to be an overnight, a little bit like equity. And we heard from Michael about all the exciting things that they're doing at the LME, particularly around pre-trade and around compliance. So, ladies and gentlemen, if you could put your hands together and please thank Michael and Yann, that would be great. Thank you.